This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Let's welcome back to the show. I'm looking forward to just having a conversation with you again. It's been a while. I was looking back. I think you were like show 970 something and maybe 300 something as well. It's been a while though since we've connected a few years anyway. So looking forward to just learning from you again, letting the listeners learn from you and your expertise. And no doubt our passive investors are going to love the show today and some of the things we're going to focus on. But give us a little update. What's happening with Lance now since you were on last a few years ago? You're focused now, and let's dive in.
Yeah, thanks for having me, Whitney. Yeah, so since the last time we spoke, yeah, I've had some pretty big changes. So I exited my partnerships I was in. We had a private equity real estate firm up in Portland, Oregon, and a fund administration company that had an investment platform, which is I think we talked about last time. So I exited there at the end of 2021 and went out on my own. And so now I spend my time. I've switched over to the operator side of the equation. So I'm working with some former clients of mine. We formed a new general partnership and we're acquiring Class B industrial properties in the Midwest, what I call the heartland states. And I've also partnered up with a passive investor, Sam Giordano, to work on it's more of a software startup, a marketplace reboot called Passive Advantage. We've got an LP deal analyzer tool that we're converting to an online tool and basically helping LPs do that. So, and I still maintain a consulting practice. I work with a lot of GPs, real estate sponsors around the country, consulting with them on fund formation and architecture and structure and how do you compensate your partner GPs and all that good stuff. So bringing all my skills and experience sort of to bear and having a great time.
That's awesome. No, I appreciate the update. I think it's helpful for the listeners to hear different ways you're adding value to others as well there. Tell me, before we jump on in, why Class B industrial? Why that asset class?
Yeah, my partners and I, we started acquiring more heavily like in 2020, kind of divesting. They were divesting from some retail stuff. The reason I love Class B industrial in particular is just it really the supply and demand imbalance. Somewhere from 2 to 3% of the supply is depleted annually. It's just tore down. It's higher, better use in urban cores, or was just the whole COVID and supply chain interruptions, the reshoring activity that's taking place. Yeah, it's much like multifamily. I mean, it still is, but certainly was even more so 7 years ago, where there just isn't enough of it and they can't build it fast enough, right? And so I think last year they onboarded 500 million square feet, which is a record, but pales in comparison to what the need is just with the growth of e-commerce and other tenant use cases, ghost kitchens, cannabis. I mean, you name it. It's just, I think it's just a great place to be. And in my personal opinion is poised to become the next sort of darling. But of course, I hope that the secret remains for a little longer, although it seems like by the day that's not proving to be the case. But and through my consulting engagements, I worked with over 200 different groups around the country, and many of them were executing industrial strategies. And so I think that was the big thing for me too, is just I've had a front row seat to pretty much every strategy imaginable with real estate. And I always liked industrial. I mean, I always had a heart for mobile home parks too, but that's certainly been oversaturated. So that's really my thesis on why
Yeah,
industrial.
it's interesting as I see probably, I mean, who knows over the next few years, but I see just more things that are being created, built, designed, industry coming back to the US most likely in a lot of ways, and more industrial buildings, the use are needing more and more, right? I think that's probably a wise move. Yeah, on your count or space, and then it's probably not as flooded yet, right? As some other asset classes with operators. So maybe you're getting in on some of the beginning of it anyway.
Yeah, I think so. I mean, it looks like in terms of competition, when we're putting offers in on properties. We're not, seeing a tremendous amount of competition, and which is usually the sign. And I feel like, especially when you feel really, really good about the basis you're getting in at, that it's not quite flooded yet. And that might be different in different areas. Like I said, we're sort of in the upper Midwest areas, but I like that area just because there's so much between waterways, rail, interstate. So much stuff moves east to west, north to south through that neck of the woods. But yeah, just super bullish on Class B industrial in particular.
Well, let's jump into helping our LPs, our passive investors, analyze the deal a little bit. And I'd love. I know you've gained a lot of experience from this and helping others, and I love the background too in helping and working with so many different operators, right, and structuring deals and the fund structures, those things. But even working through building a tool to help LPs, like I don't know, there's just a lot of knowledge that's going to be gained by fleshing some of that stuff out, right? And so let's jump in there a little bit on helping you mentioned this before we even started. It's like helping them make better informed decisions, right? As they're investing, and even as an LP myself, it's like I'm always looking to learn, right? Always looking to for the other questions, not only for me to ask operators as I'm investing, but also so I'm prepared, right? As as LPs come to us, like I want to make sure myself or my team, we also have the answers, that, hey, we've thought through those things, right? Or check those things out, or we know those things for our LPs. And so when they come to us with those questions, we have the answers. And I feel like it's just a continual growing process, right? There's always some LP that asks me something like, well,
Yeah.
I'm gonna put that on the list.
Yep.
Right, so we know we know to figure that out next time, but ahead of time, but anyway, let's dive in there a little bit, and maybe we start at an elementary level, but then I'd love to dive in a little more on some complex things that you're helping piece to learn and to, be better and make better informed decisions as we invest.
Yeah. I mean, I think at the high level, right? I mean, you have to start with each of these asset classes is different. And I think the good news over the last 7, 8, 9, 10 years is that we've really seen a lot more LPs or passive investors become really comfortable with the moving parts in multifamily deals. I mean, there's always more to learn, as you said, but I think just on whole, and the value add strategy in particular, in the podcast that I had done, I only did 115 episodes, so nothing, not like you did, but it was the real estate risk report, right? And I just think it's always important to step back and really try to think through with any offering that's put in front of you is just read those risk disclosures. They were written by an attorney. Don't freak out, but just try to internalize them and convert them into something more tangible. Right. And so I think that's first and foremost is just understand what kind of risks you're facing. So like if you're buying a core multifamily deal as an example, I mean, you don't have development risk. You don't have rehab risk or construction risk. There's just those risks are off the table, right? And so, of course, when you remove risk from the table, that means that the expected return will be lower vis-a-vis if they existed. And so, how occupied is the building? Just things like that. Just trying to think through like what could go wrong or what are the risks. Obviously, you have things that we can't control, like floods and hurricanes and fires, things like that. And of course, those are
Of course.
risks, but they can't necessarily be entirely or even close to entirely mitigated, right? So I think that's where I always start. Like as it pertains to industrial, or I mean any of these, you have to look at what are the key drivers that make the business plan move, right? And those are the variables that you want to spend the most time looking at. So in the case of industrial as an example, you've got the building or buildings, if there's a portfolio of them or whatever, and they exist in a given location or market and submarket. But you've got really the big driver is the lease, right? The leases that exist or in place on the given property and the tenants who've executed those leases, right? Which I think is a bit of a difference from like multifamily where leases are generally 1 year long and you don't necessarily, and as long as they can pay the rent, you're not really worried about underwriting the tenant so much, right? I mean, are they good people and have not had trouble in the past? It's just pretty simple. But in the case of industrial, if it's a local firm, it's only been in they're a fencing company or something, they've been in business for 3 years, that's like a local tenant, then there's more risk, right? Because the risk of them defaulting on the lease is higher. Whereas if it's a national credit tenant or investment grade tenant, someone who's actually has a credit rating with a ratings agency, things like that, then your risk is lower. But once again, that also means that your return will probably be lower, right? So you have to look at those those things when you're assessing the building. It's like, who are those tenants? And then looking at the leases, because even the best investment grade tenant, that lease might not be favorable, right? You might have a 15-year lease and the rents are 50% below market or just things like that. I mean, you can't get out of it, right? So assuming they're going to honor their lease, which if they have that kind of investment grade rating, then they're probably stuck with it. And that drives your NOI. So the building's value is driven by NOI, right? So it's looking at those moving parts. And then I think the thing I like most about industrial is that really the building is probably it's not as important, right? And so when we talk about like class B versus like class A in industrial, it's more of the nondescript buildings you drive by that were built 20 years ago or 25 or 30 years ago. And the things that matter most or that can really sink you is the condition of the roof, right? Maybe the parking lot. But oftentimes these are triple net leases or maybe even absolute triple net lease where the tenant is really responsible for property taxes and insurance and those other things that can make a big difference, like in a multifamily deal. We've seen the rise in insurance rates or property taxes. In the case of a triple net lease, that's the risk that your tenant's taking. And once again, to the degree that they are a strong tenant, they can absorb those things. So it's really, those are the things we look at more so in industrial. But I think you have to do the same exercise with each of them. Don't overcomplicate it. Just try to think through like, what are the main drivers and what are the big things that can sink you, rather than focusing on the things that, not to say they're not important. If I'm going to spend any effort and energy and mind power, I'm going to put it on the things that matter most.
I think the more I'm thinking about it as you're talking about it, I feel like we all hear the terminology or the wording of risk, knowing your risk and your risk tolerance and all these things that we almost are complacent about it. Like we hear it so much, it's just like we don't think about it as much. And why I'm saying that too is that like I feel like a lot of times as an LP, we don't think about the risk versus reward, like you were talking about, or it's like something in a deal doesn't go exactly as planned, and investors are like they're upset, right? And maybe rightfully so. But I think too, oftentimes it probably was known that that was a risk probably going to happen, but they didn't really internalize in the beginning that that's pretty likely that's going to happen. Does that make sense?
No, it makes perfect sense. I think that's where, when it comes down to then the terms that are extended to the LPs, that's what you have to keep in mind, is to say, because once again, if you don't assess the risks that could be there, that could be actualized first, then you'd have no way of then backing into and giving them weighting right on the return. So if I'm telling you that I can get you into one of our industrial deals and it's projected at 11 or 12% cash on cash return with a 3x equity multiple and an IRR that equates to high 20s or whatever, right? I mean, if you've done the risk analysis, then you can start to back down and say, well, if any of these risks are actualized, then I can appreciate that risk premium, that if things pretty much went as planned, that's what I was being compensated for, was for taking said risk. Now, if those things actualize, then that means that might have only getting an 8% or maybe less, right? Like who knows what you could get. But I mean, that's why we got the risk-free treasury rate as sort of what's the thing that's closest to a guarantee. And then you build up from there. I mean, in us as operators, we do the same thing. We look at the cost of debt and then we say, can we get in at some amount of basis points or 2% above whatever our interest rate is, and execute our plan and get it to a yield that's something higher than that, right? And that's how we assess the deal, like as the active deal makers, right? But then when it translates to the LP, that's what you have to be thinking about, is that how do I protect my downside risk? should this operator not be able to execute as planned, or should the risks actualize that maybe they couldn't completely mitigate? But like, I think that's the right process for thinking about it, is like when you see that return. And conversely, LPs, I think, need to do the opposite, is that when something's coming to them with what they think looks low, because everyone got really used to that
Right.
multifamily boom and whatever, they need to look at it and say, okay, well, what are those risks? And maybe that's still a good investment on a risk adjusted basis.
Yeah, and I do. I agree with you completely as far as this, what you call the multifamily boom, right? And it really has set this like expectation that leads a lot of LPs to be disappointed with the projected return now, right? But I feel like too, I think it's a lot of operators now are maybe have learned to be more realistic. You know,
Yeah.
in some regards of setting those expectations. I know even us, we early on, we thought we were being transparent and communicating everything with investors. And as we've learned, right, in more and more deals and more discussions with investors, like we're trying to be just like over the top, more, even more transparent, more like setting accurate expectations, right? Like where we thought we did before. And it's like we've learned, okay, still need to do a better job at this, right? And ensuring LPs understand what could happen or what might happen or just what to expect, right? That it may not always be like it was 3 years ago or 5 years ago.
Yeah, that's
So,
right.
so
That's exactly right. It's all about setting expectations.
that's right. Lean into the industrial piece maybe a little bit for our LPs and just the questions that they should be asking the operator that maybe that they wouldn't know to ask, right? And I could see investors, even the multifamily investors say that's been in multifamily a long time now, thinking about industrial as maybe the next asset class, but maybe not knowing exactly some things that they should know about industrial, right? Or they should be asking the operator. What are some of those things?
Yeah, I mean, I think, one of the big ones is just how do you go about leasing the property up? Like, okay, great. So you've got your weighted average lease term at acquisition, which means how long are these leases left on the books? If it comes back and says 24 months, then it's like, well, how are you going to go about backfilling those tenants should those existing tenants not renew? So I think it'd be similar to how retail operates, right? Like that's a big driver. Like having those skill sets or ability to do that is a big driver. Meaning if somebody just rolls in and just decides suddenly that they're going to start buying industrial and hasn't done it, they're probably going to be at a pretty big disadvantage because it's very broker driven from the leasing perspective, even more so probably than the buying. So you might be able to acquire one, but just understanding that. And of course, like we do tend to buy more single tenant buildings, but there's more risk to a single tenant building, right? And of course, it all depends upon the strength of the tenant, right? But the whole building could go dark if one tenant decides to move out, right? So just understanding, that. Whereas if it's like one of these flex parks, multi-tenant where they've got 40, 50 tenants, that's going to be more laborious to manage. But finding a large building that was 2 or 3 or 4 tenants, right, might be able to diversify it more. So just really getting comfortable that the operators understand that aspect of it and don't get as hung up on the property management or whatever. I mean, because let's face it, you got three tenants in a building. I mean, they're all sending you a check every month. Like the property management piece isn't nearly as challenging or difficult as it would be in multifamily, where I personally, who's the property manager in multifamily is looming large in my mind. And I think many people are seeing that it can make a big difference
For sure.
who's managing the property. So I think that's the big thing to hone in on, is just what are you bringing to the table in that regard? And like in my case, like my partners, he's been doing this for 20 plus years, a lot of it in retail, but retail industrial just have a lot of similarities in that regard, but it's all about who you are and the relationships that you have. And in the acquisition that we're working on right now is a perfect example of that. The building sat vacant it was an owner operated building. It's had vacant for a year and they tried to lease it and could never lease it. We get under contract as a vacant building with basically a tenant in our pocket. And so that's the different ways. That's how we add value. A value add industrial deal isn't the same as a value add multi. We're not doing a bunch of construction necessarily. That's not necessary. It's all in the financial engineering around the leases and the tenants.
And then the tenant may do the construction, right? Improving
Yeah.
the
And
building.
once again, and you might be able, that's the other benefit with the supply and demand imbalance is that we're seeing rates continue to go up and up and up because there's just not enough space. So, but that's the same thing. It's just, you might, to sweeten the deal, negotiate some tenant improvements, but it's all negotiation. So you're just looking for operators that have got strong negotiating skills, know what they're doing, have a Rolodex, relationships with tenants, and certainly owners, the ability to acquire these things at the right price too.
Is it, of course, we've never done any industrial at LifeBridge. And so I just wondered, is it common for the management to be done in-house? Or do you still hire a third party for most
Yeah,
industrial?
no, it's super common. It's common for that reason because it's
Much more simple.
it's much more simple, right? And so even if, because the things on a triple net lease, that you're responsible for, those are things that aren't difficult. You go find a contractor to repair the roof, or you know what I mean? Like you get 6 bids, like anyone could do that. And probably not anyone, but most people could.
I understand. Why don't more tenants buy their own buildings?
I mean, that's one of the pieces that you're seeing is just, you're seeing a lot more sale leasebacks. So a deal that we just closed a few weeks ago, and that's what it was. And I think the reason is just people realize, like, especially if they acquired the real estate a while ago, they've got some equity in it. So it's just sitting on their balance sheet and they can't use it. So you've got that dynamic. And then when it comes to just them looking out to acquire, it's not to say they don't, because of course people do, but I just think it's just optionality, and just knowing that if they're a growing business, it's the same issue you have with, or had with, office space back in the day when we all had offices. But it's just like, if you're running enterprise, you're probably trying to grow it, and then you outgrow the space and need other facilities. So they just don't want the hassle of being a real estate owner, knowing that they're probably going to end up with, if they execute their own plan and vision, they'll have 3-4 different buildings. And it just, I think it just gives them the optionality and not having to deal with the headache. But there's still, it's not to say that people don't buy their own buildings, because they certainly do. Like the deal that we're working on right now, that operator or that tenant, we've negotiated a purchase option at year 5 and at year 7 at a 7 cap. So they want to buy the building. It's just that they're transitioning out of another facility that they're leased. So they're just not ready to pull the trigger on that right now.
That makes sense. What are the, let's say, common terms the LP could expect in an industrial deal like this? Or how long is an investment? Is it different for industrial than multifamily, and some of the things they could expect?
Yeah, it's a great question. I mean, so our strategy it differs, right? You're going to have the long-term hold guys who want to hold it forever. But I mean, most of these leases are going to be 5 years, 7 years. So it could be similar, right, to a multifamily deal. I'd say that's probably average, is that they're going to end 5 years. But like, our strategy is to find stuff where the leases are close to expiring. And our intent is to, once we renew them or put new leases on the books, is to basically put it back on the market. So we're looking to turn ours more, but that's just a strategic choice that we've made. We like to turn them every 3. We buy it today, we want to sell it in 3 to 4 years if possible. Like in that case of the one deal, will probably end up being year 5. But yeah, I think that's the big thing, is just to understand that it's how the value add works and when the value add will be added, and it's going to be driven around the leases. So it's really looking at what is that weighted average lease term for the given property that you're looking at. And you can pretty much figure out about when that value add will be added. And that's, they're either going to refi it at that time and then hold it for another, couple of years and sell, or just go ahead and sell it right after that.
How have the increase in interest rates affected this asset class?
I mean, I think it has on the coasts more, where it's more competitive and not as lucrative. So, I mean, once again, the market drives some risk too, right? So, but in ours, I mean, it works. I mean, we're sort of underwriting everything to around a 7% interest rate, and we're getting local bank financing versus so I mean for us it really hasn't, because most of the deals we're looking at, we're looking at deals that are like 10 caps going in, usually in 7, 8 cap markets. Once again, it's like, so that's our strategy. It's just our strategy is we really only want to hit like triples and home runs. So it's all about getting in a really good basis. But yeah, they pencil even at a 7% interest rate.
What do you what are you expecting to say the next 6, 12, 18 months to look like just in the this real estate market in general and maybe even specific for industrial?
Yeah, I mean, I'm as interested as the next guy on the market in general, particularly just with multifamily, just what's going to happen here with the shakeout. And I just think that how all this debt ends up, how that shakes out is gonna it's gonna dramatically alter how this thing works, right? And I don't think anybody knows, and I certainly don't know, but I know that there was a lot of floating rate debt that was put on a lot of these things and bridge debt, and I just know that that's not looking good right now, because I'm in the camp that I just tend to believe that I don't think these interest rates are going to be going down anytime super soon. I just don't think that's going to happen. Maybe a little bit, but not enough to rescue those guys, right? And so, and I think you see that across the board. I mean, anybody who was of the overly exuberant sort of phase and bought wrong or at the top with any kind of debt could be in trouble. So you're going to see some amount of distress strictly because of how certain deals were capitalized. But that's how I'm looking at it. And I guess from on the industrial side, I think it should be a little bit more immune to it, but I'm hoping that I hate to, I mean, I'm hoping that we'll actually end up being able to acquire some stuff that's distressed because of the same thing, just not capitalized properly. And that's what I've always told all my advisory clients, whether it's a fund or anything. I'm just like, it really is, it's super, super important how you capitalize any asset, real estate in particular, or if it's loans or whatever. I mean, you could have performing assets that are fine, but if you didn't capitalize it properly, it can sink you. So going back to from an LP's perspective, I mean, and everyone's learning now, like, yeah, you don't just gloss over that debt slide. Like that debt slide's pretty darn important. And just understanding who's the lender, what are those terms, and the fine print. I mean, I don't know how many people I've heard from that, like somehow, some way, didn't even realize that there was no cap on their floating rate debt. Like to me, that's just, it seems crazy. Like I just don't understand that. But I think that's just what happens is people, they get moving so fast. And I do think too, just from LPs to fully understand, right? Like when operators, no matter what asset class you're in, and you tie up a deal and you go through all this due diligence, and you might get a term sheet at some point from lenders, right? But it is one of the last things to be finalized, right? Because the appraisal's got to come in, and the building report, inspection, all that stuff sort of lags. And when you're being marketed a deal, a lot of that stuff is still sort of in flight because just the timing is so tight on a syndicated deal. Right. And so there is some wobble there, and there is a chance that things can be overlooked. So just everyone has to keep that in mind, that so checklists are important and things like that, just to make sure you haven't overlooked anything.
Speak to preparing for a downturn, say in an industrial type asset, or what is it?
It's been interesting the last few years, like after being in businesses that were, I'd call more stable over the last 10 or 15 years, the things you do in those businesses are different. It's kind of, now I'm at this point where I've started from ground zero on many of these things that I'm working on. So I'm a big proponent of lean startup principles and just iteration and just focusing on the main thing and that kind of stuff. So that's more where my mindset is. It's just, don't worry about everything, worry about the important things. And I think that applies to life in general, but certainly when you're at the stage where I'm at, where you're starting a new general partnership, even if it's just industrial and raising funds, which of course for me is like falling off a chair because I've been helping people do that and running our own funds for years. But, when you got to start from scratch and all those things, you got to make sure you're focusing on the right things. And then with the software startup, it's exciting to get back into that again. And it's the same thing. It's like focus on what the customers want. It don't matter what I want. It matters what they want, and whatever they want, figure out how to give it to them and ask a lot of questions and learn what you can do to improve it and continue to deliver value to them.
No doubt about it. I love that. I love the focus. So thank you again. Tell the listeners how they can get in touch with you and learn more about you.
Yeah, I think the best way is on LinkedIn. Just search Lance Pederson, connect with me there, and we can take it from there. But yeah, I think that's the most expedient way to connect.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.